Here's what's crazy, serious. Wall Street analysts are predicting Bitcoin could hit $1 million per coin within the next decade, but most Americans are too scared to even buy $100 worth. Why are the same people who drop $50,000 on a depreciating car terrified to put $500 into an asset that could potentially 50x their investment? Most Americans think Bitcoin is either a scam or gambling. But here's what they don't realize. Some of the smartest investors alive, people who built billion-dollar companies and predicted every major economic shift of the past 50 years, are betting their fortunes that Bitcoin will eventually replace gold as the world's store of value. Today, I'm breaking down the real mathematical case for why Bitcoin could actually reach $1 million per coin, the specific fears keeping Americans paralyzed, and most importantly, how to participate in this potential wealth transfer without risking your financial future. This isn't about getting rich quick. It's about understanding a once-in-a-lifetime economic shift that could determine whether you build generational wealth or watch others build it. Comment: Million Bitcoin if you think this prediction sounds completely insane. Look, I get it. Bitcoin sounds like gambling. But here's what nobody talks about. Number 1. The $1 million case. Why Bitcoin could actually hit $1 million. The first reason Bitcoin could actually hit $1 million per coin, and it has nothing to do with hype, speculation, or getting rich quick. It's pure mathematics combined with the oldest economic principle in human history. When you increase the supply of money, each unit becomes worth less. Most Americans dismiss Bitcoin as fake internet money without understanding the mathematical case behind the $1 million prediction. They hear $1 million per Bitcoin and think it's just crypto enthusiasts being greedy. But here's what they're missing. This prediction isn't based on hope. It's based on what happens when a finite asset meets infinite money printing. Let me take you back 17 years to understand why this matters. The Roman Empire had the strongest currency in the world, the gold aureus. For centuries, Roman coins maintained their weight and purity, creating trust and prosperity across the empire. But when emperors started facing expensive wars and social programs they couldn't afford, they made a fatal decision. Instead of raising taxes or cutting spending, they began clipping coins, reducing the gold content while keeping the same face value. Emperor Nero reduced gold content by 10%, Trajan reduced it further. By the time of Emperor Diocletian, Roman coins contain less than 5% of their original gold content. What happened next was predictable and devastating. Prices skyrocketed across the empire. Citizens lost faith in Roman currency, the economy collapsed, and the empire fell. The Romans learned the hard way that you can't print your way to prosperity. You can only print your way to poverty. Fast forward to today, and we're watching the exact same pattern play out with the US dollar. Since 1971, when President Nixon removed the dollar from the gold standard, the Federal Reserve has printed over $20 trillion in new dollars. During the 2020 pandemic alone, they created more new dollars than existed in the entire US money supply in 2008. Here's the math that should terrify every American. In 1971, you could buy a house for $25,000. Today, that same house costs $400,000. Did the house get 16 times better? No, the dollar got 16 times weaker. Your purchasing power has been silently stolen through monetary debasement, just like the Romans. But here's where Bitcoin changes everything. Bitcoin has a fixed supply of 21 million coins. That's it, forever. No government can print more, no central bank can debase it, and no politician can inflate it away to fund spending programs. It's the first truly scarce digital asset in human history. Now, let's run the numbers that lead to the $1 million prediction. The gold comparison. Gold has a market capitalization of approximately $12 trillion because people store wealth in it to protect against currency debasement. If Bitcoin captures just half of gold's market share as a store of value, that's $6 trillion. Sovereign wealth funds are exploring Bitcoin allocations. When institutional adoption accelerates, the available supply for retail investors shrinks dramatically. Warren Buffett once said, "You should buy what you understand after you understand it." For decades, Buffett avoided technology stocks because he didn't understand them. Then, in 2016, after studying Apple for months, he finally understood their business model and bought $36 billion worth. That investment is now worth over $150 billion. The same principle applies to Bitcoin. Most Americans avoid it because they don't understand it. But those who take time to understand the mathematics, the fixed supply, the growing demand, the monetary debasement happening globally, start to see why $1 million per coin isn't just possible, it's probable. Here's a story that puts this in perspective. In 1995, when the internet was new, most people thought it was just for computer nerds and would never replace traditional media. Mainstream newspapers published articles titled "The Internet, oh, 9s buh." But a few visionaries understood that connecting every human on Earth would create unprecedented value. Those who invested in Amazon at $18 per share in 1997 and held through the dot-com crash, the 2008 financial crisis, and multiple overvaluation periods saw it grow to over $3,000 per share, not because they were lucky, but because they understood the long-term value of network effects. Bitcoin is the same opportunity, but for money itself. It's not just a new technology, it's a new monetary system that fixes the fundamental problems of infinite money printing and government debasement. The question isn't whether Bitcoin will hit $1 million. The question is how long it takes and whether you'll participate in the wealth transfer from fiat currencies to hard money. But that's just the obvious part. What I'm about to say is what makes the difference between understanding the opportunity and actually having the courage to act on it. No. 2. The American Dilemma. Why? You're scared, but shouldn't be. What I'm about to say is what makes the difference between understanding the opportunity and actually having the courage to act on it. Because most Americans are paralyzed by 3 specific fears that are keeping them from the biggest wealth transfer in history. Fear number 1. Bitcoin is too volatile. I could lose everything overnight. This is the most common objection I hear, and I understand it completely. Americans watch Bitcoin drop 30% in a week and think this is gambling or investing. But here's what you're missing. Volatility isn't risk when you understand what you're buying and plan to hold for decades. Let me put Bitcoin's volatility in perspective. Amazon stock dropped 80% during the dot-com crash and another 60% during the 2008 financial crisis. If you focused on the volatility instead of the long-term value proposition, you missed one of the greatest wealth-building opportunities in history. Amazon shareholders who held through the volatility saw 1,000+ % returns. Benjamin Franklin understood this principle perfectly. He wrote, "An investment in knowledge pays the best interest, but an investment in the future pays the best returns." Franklin didn't avoid risk. He took calculated risks based on deep understanding. The key insight: Bitcoin's volatility is declining as adoption increases. In 2010, Bitcoin regularly moved 50% plus in a single day. Today, 10% moves are considered significant. As institutional adoption grows and market cap increases, volatility naturally decreases. You're not too late. You're early enough to benefit from decreasing volatility while still capturing massive growth. Fear number 2: missed the boat. Bitcoin already went from 1 to 50,000. This is classic American FOMO psychology working against you. You see Bitcoin's past performance and think you missed out, so you avoid it entirely. But this is exactly backwards thinking. Here's the historical perspective that changes everything. In 1995, people said they missed the internet because some websites were already worth millions. In 2005, they said they missed social media because MySpace was already huge. In 2010, Fidelity, BlackRock, and other traditional financial institutions offer Bitcoin services to clients. More importantly, the government has a strong incentive not to ban Bitcoin because it would drive innovation and tax revenue to other countries. China banned Bitcoin, and the US benefited as Bitcoin mining and development moved to America. But here's the deeper truth. Governments can't effectively ban Bitcoin, even if they wanted to. It's decentralized across hundreds of thousands of computers worldwide. Banning Bitcoin would be like trying to ban the internet, technically impossible and economically destructive. The real risk isn't government bans, it's government debasement of your savings through money printing. Bitcoin is insurance against that debasement, the insurance mindset that changes everything. Here's the reframe that eliminates fear. Stop thinking of Bitcoin as a risky investment and start thinking of it as insurance against monetary debasement. You buy homeowners insurance not because you want your house to burn down, but because you want protection if it does. Similarly, you buy Bitcoin not because you want the dollar to collapse, but because you want protection if it continues to weaken. If Bitcoin goes to zero, you lose your insurance premium. If the dollar continues to weaken, which is mathematically inevitable, given current money printing, your Bitcoin insurance pays off massively. Here's your actionable sleep well at night strategy. Allocate 1 to 5% of your investment portfolio to Bitcoin, a fifth your life savings, just 1 to 5%. This allocation gives you meaningful upside if Bitcoin succeeds, without risking your financial future if it fails. Think about the asymmetric risk-reward. If Bitcoin goes to zero, you lose 1 to 5% of your portfolio. If Bitcoin goes to $1 million, that 1 to 5% allocation could become 30 to 50% of your net worth. That's the definition of a smart bet. Limited downside, unlimited upside. The wealthy understand asymmetric bets. They risk small amounts for potentially life-changing returns. They don't bet the farm, but they don't avoid the game entirely. Let me share a story about fear versus opportunity. In 1876, Alexander Graham Bell offered to sell his telephone patent to Western Union for $100,000. Western Union's board rejected the offer, calling the telephone nothing but a toy. They feared investing in unproven technology. 10 years later, Bell's telephone company was worth $25 million, and Western Union was desperately trying to compete in the telephone business. Their fear of the unknown cost them the biggest business opportunity of the century. Don't let fear of Bitcoin's volatility cause you to miss the biggest monetary shift in your lifetime. The people building generational wealth aren't the ones avoiding risk. They're the ones taking calculated risks based on deep understanding. Wait, there's something you need to pay attention to if you don't want to lose everything you've worked for by either avoiding this opportunity entirely or approaching it recklessly. Number 3. The smart strategy. How to invest without gambling your future. There's something you need to pay attention to if you don't want to lose everything you've worked for by either avoiding this opportunity entirely or approaching it recklessly. Because most Americans make one of two fatal mistakes with Bitcoin. They either go all in like it's a lottery ticket, or they avoid it completely like it's radioactive. Both approaches are wrong, and both will cost you generational wealth. The all-in crowd treats Bitcoin like a get-rich-quick scheme. They put their life savings, retirement funds, and even takeout loans to buy Bitcoin at market peaks. When volatility hits, they panic, sell at losses, and swear off crypto forever. These people turn a generational opportunity into a financial disaster through reckless position sizing. The avoid completely crowd treats Bitcoin like it doesn't exist. They wait for more certainty or less volatility while watching the price climb from $10,000 to $20,000 to $50,000. They're so afraid of losing money that they guarantee missing the opportunity entirely. But there's a third path, the path of the wealthy. They understand something that both extremes miss. The goal isn't to maximize potential gains or minimize potential losses. The goal is to optimize for asymmetric risk-reward while protecting your downside. The ancient Roman emperor Marcus Aurelius mastered this principle. He wrote, "Confine yourself to the present, but balance the present with preparation for the future. Take neither excessive risk nor excessive caution. Both lead to ruin." Marcus Aurelius understood that true wealth comes from calculated positioning, gambling, or paralysis. He took measures. If Bitcoin goes to zero, you lose 5% of your portfolio. If Bitcoin hits $1 million, that $5,000 could become $200,000 plus with the dollar cost average approach. Don't try to time the Bitcoin market, you'll fail. Instead, Buy a fixed dollar amount every month, regardless of price, $100, $200, $500 monthly, whatever fits your budget. This smooths out volatility and eliminates the emotion from your buying decisions. The set it and forget it mindset. Buy Bitcoin like you buy index funds consistently, automatically, without checking the price daily. Set up automatic purchases and resist the urge to trade. The people who built wealth with Bitcoin held through 80% crashes and 1000% rallies. The secure storage protocol. Never leave Bitcoin on exchanges. Use hardware wallets like Ledger or Trezor to store your Bitcoin securely. Think of exchanges like hotel safes. Fine, for temporary storage, but you wouldn't keep your life savings there. The time horizon reality check. Only invest money you won't need for 10+ years. Bitcoin's volatility can be extreme short-term, but the long-term trend is up and to the right. If you might need the money in 2 to 3 years, don't invest it in Bitcoin. Let me tell you a story that illustrates why this measured approach works. In Aesop's fable, the tortoise races the hare. The hare sprints ahead early, gets overconfident, takes a nap, and loses the race. The tortoise moves slowly but consistently, and wins through persistence, not speed. Most Bitcoin investors are either hares going all in, then burning out, or they don't race at all, avoiding Bitcoin entirely. But the smart money moves like the tortoise. Consistent, measured, persistent action over time. Jim Rohn taught this principle. Success is a few simple disciplines practiced every day, while failure is simply a few errors in judgment repeated every day. The discipline of consistent small Bitcoin purchases over the years creates wealth. The error of either avoiding Bitcoin or gambling on it destroys wealth. Here's the specific implementation plan. Month 1. Open accounts with Coinbase or Kraken for buying and order a hardware wallet for storage. Month 2. Start with $50 to $200 monthly automatic purchases. Set it up like a utility bill, automated and boring. Month 3. Transfer your Bitcoin from the exchange to your hardware wallet. Learn proper storage and backup procedures. Months 4 to 120. Continue automatic monthly purchases regardless of price, news, or emotions. Don't trade. Don't time the market. Don't get clever. Years 10+. Evaluate your position. If Bitcoin succeeded, you'd have captured life-changing gains. If it failed, you lost 1 to 5% of your portfolio. A small price for a generational opportunity. The key psychological insight: this strategy removes FOMO, fear, and trading emotions. You're not trying to get rich quickly or avoid all risk. You're taking a measured position in a potential monetary revolution while protecting your financial foundation. Modern portfolio theory supports this approach. Nobel Prize-winning research shows that adding a small allocation of uncorrelated, high-potential assets actually reduces overall portfolio risk while increasing expected returns. Bitcoin fits this profile perfectly. The wealthy don't avoid all risk or take excessive risk. They take calculated risks with asymmetric payoffs. Bitcoin, approached intelligently, represents the ultimate asymmetric bet of our lifetime. All of the above will be meaningless if you miss the last detail about why. This isn't really about Bitcoin at all. It's about positioning yourself for the great monetary transition that's already begun. Whether you participate or not, here's the brutal truth. We're living through the end of the dollar-dominated monetary system that's existed since 1971. Central banks worldwide are printing money at unprecedented rates, creating the largest wealth transfer in human history. The only question is whether that wealth transfers to you or away from you. Bitcoin hitting $1 million isn't just about cryptocurrency succeeding. It's about fiat currencies failing. When dollars become worth less, hard assets become worth more. Gold, real estate,